Okay, cool. Thanks, Tony. Tony, as usual, you gave me a reason to shower. It's been a few days, and all these Finance in the Cloud conferences are pretty cool for that reason alone. So this is our first foray into issues around human capital, education decisions, student debt decisions. And in particular, we're interested in how being affected by climate change like disasters are affecting people's decisions on whether to go to college. To give you a little bit of background on our setting, we're using Hurricane Harvey. Hurricane Harvey hit the Houston area right as the 2017 fall school year was beginning, so right at the end of August, early September. It stalled over Houston, and if you've ever wondered what a 27 trillion gallon raindrop hovering over the city of Houston would look like, here you go. It was the single largest amount of rainwater ever recorded in the continental US from a single storm. And so it's not surprising then that it submerged over a quarter of the Houston metro area. It caused $125 billion in damage, of which only $19 billion was insured. And Harvey was second in cost only to Hurricane Katrina, which hit New Orleans in 2005. To give you a sense of what the flooding looked like over Houston, here you go. So you can see that it sort of hit all sides of Houston. And if we take this little strip right here and we zoom in on it and overlay the 100-year flood map, you can see that there are a lot of parts of Houston that were outside the floodplain but flooded, and there are also places inside the floodplain that did not flood. And that's kind of unique to Hurricane Harvey in Houston. If you look at other gigantic disasters that we've had, say Hurricane Katrina, most of New Orleans is under sea level. So most of the area that flooded was in a floodplain. And that wasn't true for Hurricane Harvey, and that's important because of expectations of flooding as well as who had flood insurance and who didn't. And we're going to try and use that to the maximum ability in this paper. It wasn't just Houston that flooded. So Hurricane Harvey hit a big chunk of southeast Texas. It hit 40 counties, flooded them badly enough that FEMA offered individual assistance to flood victims in those 40 counties. So we're also going to use this factor as well. Our research question here is, how does exposure to a major wealth-destroying natural disaster like Hurricane Harvey influence human capital decisions? Why is this an important question? Well, a couple reasons. First off, the US privately funds a large share of education, right? We charge very high tuition amounts to private individuals to get educated. And that's kind of unique in some sense to the US among developed countries. And then second, the US is really exposed to climate change in a lot of ways. So if you take just the last 20 years, so take the year 2000 to 2019, we've had 48 separate billion-dollar tropical cyclone and flooding disasters. Now go back in time to the 20 previous years, so the 20 years ending in 1999, we had 30 such events in that period. So we've essentially had like a 60% increase in the frequency of these events. And so this is obviously an increasing threat to household wealth. So it's important to understand how that might be affecting individuals' decisions on whether to get educated. What are we thinking in terms of mechanisms? Basically, three mechanisms come to mind. I think Constantine has highlighted a couple other ones that we haven't considered yet. But the three ones that we have in our heads are wealth effects, liquidity effects, and then opportunity costs. So wealth effects and liquidity effects, these come from the fact that if your house floods, you lose wealth. So we document that after Hurricane Harvey, there was at least a 12% discount for flooded properties in the first couple quarters after Harvey. And what that means is if you have like a typical buffer stock or life cycle model in your head, households that flood, they have this big loss of wealth. they're going to want to consume less education. They're going to be hesitant to take out debt to fund it. And then liquidity effects. So something like 1 in 5 households will extract equity to pay for college when mortgage rates are lower than student debt interest rates, which was the case during Hurricane Harvey. Mortgage rates were historically low and certainly less than student debt interest rates for graduate school, especially. And so if you can't extract equity, you are going to have more trouble financing education. Third mechanism is the opportunity cost of attending college. So if there's a lot of flooding in your neighborhood, all of a sudden there are many construction job opportunities. And so you're foregoing a higher wage by attending college. If you put all of these 3 mechanisms together, they should all predict less human capital investment after flooding. So we're going to try and test for that. The implications, inequality, education has been widely cited as one of the ways of reducing inequality. So you can imagine inequality could get worse in areas affected by these disasters, brain drain, and then a resulting loss of high-skilled industries in a disaster-prone region. Policy implications. 1, it's how we fund education. And 2, how we allocate disaster assistance. So there's currently, after these storms, there's no sort of direct aid to help students pay for college. And the aid that people do receive is pretty, there's a lot of frictions involved. It's hard, if you get flood insurance, the mortgage lender controls the payout. If you get a FEMA grant, FEMA will earmark the funds to pay for rent or repairs, and they could audit your receipt. So it's not that easy to allocate the disaster assistance that people do receive to college tuition. And this is something that is actually different during the pandemic. In the CARES Act of 2020, there is some money that's meant to go to students in the form of relief grants. So that's an interesting difference. Okay, so what is our setting? So our setting is Hurricane Harvey, and we're using this mainly because the wealth shocks in Hurricane Harvey were allocated quasi-randomly. Only about 6% of the variation in flooding across Houston's census blocks can be explained by predetermined socioeconomic and geospatial factors, things like distance to streams, elevation, etc. And in fact, the majority of flooded structures were actually outside of the floodplain under Harvey. So this led to a big hoopla, and FEMA is currently redrawing the maps because they were just so incredibly inaccurate. But the nice thing about this is we can differentiate treatment effects by floodplain status. So we can look only at flooded properties that were outside the floodplain where people are likely uninsured and we're not expecting to be flooded. Our outcomes are, so we're going to run 2 separate analyses in this paper. In the first analysis, the outcome is at the school level. So we use Texas universities and colleges, and we look at their enrollment and graduation rates as well as their time to degree. And to get variation here, we're going to use variation in the share of a school's student body that is coming from high schools in the 40 Texas counties that severely flooded during Harvey. Our second outcome is we're going to look at individual level student debt outcomes within Houston. And the basic insight here is that student debt, it can work as a proxy for human capital investment to the extent that house price declines lead to a loss in home equity, forcing those individuals that were extracting equity to pay for college or intended to extract equity to pay for college to now substitute into student loans if they want to finance the same level of human capital accumulation. So you lose a lot of home equity, you're going to be forced to take out more loans if you want to maintain the same level of education investment. So if we were to find an increase in student debt, that would kind of have an ambiguous interpretation. But if we find that student debt decreases in the aftermath of this storm, that would signal that less human capital is being obtained. So that's what we're going to look for. And the variation that we're going to look for to try and identify the variation that we're going to use to try and identify this is we're going to use within Houston differences in flood intensity across census blocks. Okay, to give you a preview of the results, Harvey, we find negative schooling effects, and the schooling effects we find are substantial enough that we're able to identify them in this really intent to treat format. Right, we don't see the exact flooding incurred by individual students, but nonetheless, given the variation across Texas counties and across Houston census blocks, we're still able to pick up negative schooling effects. So, for example, we find an almost 9 percentage point enrollment decline at schools that were most exposed to the disaster from a student body perspective, relative to schools that had very few students coming from disaster-affected Texas counties. Similarly, we find a decline in the four-year graduation rate and a small increase in the time it takes people to complete their degrees at these schools. Looking at the student debt results, we find that college-age adults from the most heavily flooded parts of Houston are 2.5 percentage points less likely to have a student loan. And this is mainly driven by students that had no loan to begin with. So these are young people who had no loan, and then Harvey hits, they become less likely to take out a loan, which might signal a delay in their willingness to start college. We also find some evidence that this is linked to being mortgage holders, people located outside the floodplain who likely didn't have flood insurance, as well as people who have less initial equity in their homes. These people seem to be less likely to grow their student debt balances after flooding. And these effects, they all persist through the end of our sample period. So Harvey happened only 2+ years ago, about 2.5 years ago. So we don't have a long time period afterwards. And now the pandemic has happened, which is going to compromise our ability to carry this analysis further. So where does this fit into the literature? There is a absolutely massive literature linking financial constraints to human capital outcomes. I would start off looking at the literature linking housing booms and busts to college attainment and student debt. And really the evidence here is mixed. Some papers find a pretty substantial effect of housing booms and busts on human capital outcomes, and others they don't. It seems to depend on the setting. There's also a large literature linking financial constraint, things like tuition, subsidies, Pell Grants, and debt to human capital decisions, and these tend to show pretty large effects. I think an interesting aspect of this literature, coming to it from the outside, is that in this literature, effects tend to persist. Why do they persist? Well, decisions not to go to college, they tend to persist because the time to receive the gains from college shrinks while other obligations increases. So things like the need to support a family, these things increase with age. And so this literature tends to show that schooling effects persist. But all of this literature has a big identification hurdle. All of these things like college going, tuition, subsidies, wealth, labor markets, they're all endogenous. And so everybody in this literature seems to have to find a pretty creative identification strategy. So I think one contribution we're making here is showing that a natural disaster can offer a plausibly exogenous source of variation in wealth that can be used to understand the effect of constraint on human capital decisions. And then secondly, I think this is, to my knowledge, this is the first paper to look at how natural disasters are affecting short-term higher education decisions. So in the context of climate change, that seems relevant. Okay, so I'm going to get into the analysis. As I mentioned, we do two analyses in this paper. The first analysis, everything's at the school level, and we're going to look at higher education outcomes using data from the Texas Higher Education Coordinating Board. We've got all Texas public universities and community colleges. And our treatment here is we look at the school's enrollment from the Texas counties that were most damaged by Hurricane Harvey. And we're going to rank each school each school's disaster enrollment share within type. So we're not comparing community colleges with universities, which community colleges are obviously pulling more local students. And so we run a treatment intensity diff and diff, where the beta can be interpreted as the post-hurricane differential average effect of being the most enrollment exposed school relative to the least enrollment exposed school within a school type. And here are some event study plots. We don't have a ton of data here, so we've got 112 schools in the sample, but you can see that there is this sort of decline in enrollment, particularly in the first fall semester, and then it comes back the next fall semester. And you see this increase in time to degree and a drop off in the four-year graduation rate. Some of these variables are available at the semester level and others at the annual level, which is why you see different numbers of dots. To put this in a more formal context, so that enrollment drop off, it's an 8.9 percentage point drop off at the most exposed school relative to the least exposed school. Time to degree increases modestly, so that is about 0.15 years or 3.5% of the average amount of time it takes a student to graduate in our sample. And this effect is significantly larger in the case of time to degree for schools that are serving students with student debt. So we're using the share of students with debt as a proxy for the amount of constraint that going to that school imposes on its students in general. And you can see that time to degree seems to get larger with that outcome, which might signal that there's some substitution occurring from full to part-time schooling, as financially distressed students might be working while attending school. That's one interpretation of what might be happening there. And then the graduation rate, you see a 3.9 percentage point, or pretty substantial, almost 14% relative decline in the four-year graduation rate at the most exposed school relative to the least exposed school. So the general conclusion here is that disaster-affected students, even if they remain enrolled, they may take fewer class hours and thus take more time to graduate. Okay, so the second analysis is that student debt analysis that I talked about, and we're using student debt here as a proxy for human capital accumulation. The reason that we're doing the second analysis is for a couple of reasons. First off, you saw at the school level, we didn't have a huge sample size, 112 schools. That's not fantastic. And then also you run into this problem where, the flooding was geographically concentrated in Southeast Texas. So, you have the potential here for common shocks to be associated with the school's proximity to Southeast Texas. So you can imagine that if that, for example, faculty quality could be affected. If you're located near areas that flooded, your faculty might have been affected. Faculty quality could decline, and that in turn could affect student outcomes. So you have some identification concerns with just looking at things at the school level. So we want to use student debt as a proxy for human capital accumulation. And again, this only works to the extent that housing wealth is used to finance education. So if you lose housing wealth, you must substitute into student loans if you want to obtain the same amount of education. So if we find a decrease in student debt among flooded borrowers in the Houston area relative to not flooded borrowers, then that would signal that less education is being accumulated. And a nice feature of this approach is that we're using within Houston variation in flooding. So as long as the same labor market opportunities are available to people in flooded and in not flooded parts of Houston, any effects we find here should presumably speak to the wealth impact of flooding rather than, say, labor impacts like foregone wages. Okay, so our data set here, we're using the New York Fed Equifax Consumer Credit Panel, lovingly referred to as the CCP. And we've got over 120,000 individuals in there with credit files. We've got data through the end of 2019, and about 7,000 of those individuals were college-aged adults when Harvey hit. Note that you just have to have any sort of credit file to be in our sample. We're not requiring that you have a credit score, because if we did that, we would lose a lot of college-aged people. But anybody who's even been a authorized user on their parent's credit card would be in our sample. And then we run this treatment intensity diff and diff. Thanks. This treatment intensity diff and diff, similar to before, and treatment is how much flooding occurred in the block of residence. So luckily, students, they typically use a permanent address, that's their parents' house. And they're actually advised to do so by potential credit sources to use their parents' house as a permanent address. And so we're going to use the weighted average flood depth in the census block of that address, and we're going to split it into terciles. So the top tercile is the most flooded tercile of all blocks that had some flooding in them. And we're going to assign people to this treatment intensity based on where they lived as of the dawn of the hurricane, so Q2 2017. So they're allowed to move around. We keep their treatment intensity constant based off of where their permanent address was as of the dawn of the hurricane. So here the beta can be interpreted as the post-hurricane change in blocks of a given flood intensity relative to the post-hurricane change in blocks that did not flood. So I think the extensive margin results here are sort of the main results of interest. And we're using that simple diff and diff model where this blue part here, that's the effect of being in the most flooded tercile of flooded blocks. And then these red diamonds are the effect of being in the low to mid flooded area. And all effects can be interpreted as relative to the no flood, the omitted no flood census blocks as of Q2 2017. And you can see when we split people up by age groups, in this college age sample, your extensive margin probability of having student debt declined substantially after Harvey. And you know, this is pretty large. That reaches a 4 percentage point effect, and it doesn't seem to come back, right? Like you're not seeing it drop for a semester or two and then come back. It's all the way down through the end of 2019. We also, you know, what we really are interested in are students who have no student debt. They're approaching college and they're deciding whether to go to college, knowing that if they go to college, they have to open a student debt account. So to get at these people, we use a discrete time hazard model. It's basically the same thing as a diff and diff, but we restrict our sample to people who don't have any student debt as of just before the hurricane. And we look at how you know, the hazard of opening student debt over time by treatment intensity, by flood intensity. And you can see that this effect up here is largely coming from those college-age folks that did not have student debt as of the dawn of the hurricane. And again, this is a pretty large effect. We're getting at maybe 2.5–3 percentage points by the end of the sample. And you don't really see much effects on the extensive margin for the other age groups, maybe a little increase for the mid-age group as they have potential trouble paying down their pre-existing student debt. So all this right here is signaling that some people are perhaps not starting college. Looking at the intensive margin, so these are people who had pre-existing balances, and we're interested in how those balances evolve over time. Again, in the full sample, small increase, not much happening, but if we focused in on those college age students, you get a insignificant decline in the intensive margin. Now, if you focus in on those college age students that had their permanent address located outside the floodplain, meaning their parents probably didn't have flood insurance, and the cost of flooding was probably not priced into their home to begin with. Among this sample, you see this big drop off in the intensive margin of student debt. By the end of our sample, it's about $3,000. They have about $3,000 less than counterparts in parts of Houston that did not flood. If we don't restrict by age, but instead just look generally at floodplain status and mortgage holders, you see a similar pattern. So this is in log form. So that right there is looking like around a 4 percentage point drop, 4% drop off in balances outside the floodplain. Look at mortgage holders. Again, you get a bit of a dip. If you look at mortgage holders located outside the floodplain, you get an absolutely massive dip. This is, you know, potentially like a 5 or 6% drop in balances. So this could signal that some people, so older people who still go to school, like nursing school and graduate school, who were doing ongoing education, have decided not to keep doing that ongoing education in the aftermath of the storm. Okay, to wrap up here, we find this non-trivial decline in enrollment and four-year graduation rates at schools that serve students who came from the parts of Texas that were most impacted by Harvey. And we also see this increase in time to degree. It's suggestive to us that that some of the students who are remaining enrolled might be switching more to part-time education, working while they attempt to finish school. And then with the student debt results, you know, if flooding has no effect on human capital decisions, then a wealth shock should cause students to need more student debt financing. When we started this project, when we started, we thought that we would find an increase in student debt, but instead we find this decrease in student debt, which is consistent with the idea that students might not be accumulating as much human capital. Particularly college-age students, people located outside the floodplain, and mortgage holders. I didn't get to show you this, but among that pool of mortgage holders, it's largely those that have less equity in their homes. So they bought their homes maybe only 5 years ago. Those are the ones where you really see a drop-off in their intensive margin balances. You put this together, it suggests that financial distress imposed by flooding reduces human capital investments. And you know, the scary thing here is the effects persist for at least 2+ years after Harvey. I think it's too soon to say whether Harvey led to a sort of permanent education scarring or if people will eventually catch up. I think a really interesting area for research is to use the 2020 CARES Act, in which universities were allocated funds to specifically give their students relief grants, and universities are doing this in different ways. There's some discretion in how they allocate these relief grants to students, and seeing if those relief grants have any benefit on educational outcomes, because in the aftermath of natural disasters, there's really no policy that is geared at keeping students enrolled in college. And so that might be something we want to look at going forward. I like to end my Harvey papers with a nice apocalyptic picture. And I usually show this like when things are good and times are great and we're not actually in an apocalypse, but I guess it's less funny now. Okay, thank you.